Many savvy investors are always looking for ways to optimize their tax situation, especially by employing strategies like tax loss harvesting. This involves selling an investment for less than you paid for it to offset capital gains or even a limited amount of ordinary income. However, there is a very important rule that can unexpectedly trip up even experienced individuals. The wash sale rule applies when you sell an investment at a loss and then, within a specific time frame, purchase a substantially identical security. This rule prevents you from claiming an immediate tax deduction for that loss. It is a critical consideration for anyone engaged in tax loss harvesting strategies. The Internal Revenue Service, or IRS, established the wash sale rule to prevent investors from artificially generating losses for tax purposes without truly altering their economic position. Essentially, if you sell a stock for a loss, but then immediately buy it back or buy something almost exactly like it, the IRS views this as if you never really got rid of the investment. The rule specifically defines this as buying the same security or one that is substantially identical within 30 days before the sale, on the day of the sale itself, or within 30 days after the sale. This creates a 61-day window around the loss-generating transaction. The IRS wants to ensure that a true economic loss has occurred before allowing a tax deduction. If a wash sale occurs, the disallowed loss is not permanently lost, but rather added to the cost basis of the newly acquired, substantially identical security. This effectively defers the tax benefit until the new security is sold in a non-wash sale transaction. Furthermore, this rule applies not only to your own transactions but also to those of your spouse or any entity you control. To skillfully navigate the wash sale rule, advisors need to ensure clients understand what constitutes a substantially identical security. For individual stocks, it means buying back shares of the exact same company. For exchange-traded funds or mutual funds, it can be more nuanced, involving funds that track the same index, sector, or have very similar investment objectives and holdings. A practical way to avoid triggering a wash sale is to simply wait the full 31 days after selling for a loss before repurchasing the same or substantially identical security. Alternatively, you can sell the losing investment and immediately reinvest in a similar but not substantially identical fund or stock, maintaining market exposure without violating the rule. Carefully tracking all buy and sell dates is paramount. It is also important to remember that the wash sale rule applies across all your investment accounts, including individual brokerage accounts, joint accounts, and even individual retirement accounts, or IRAs. A common mistake investors make is selling a stock for a loss in a taxable account and then buying it back in an IRA within the 61-day window. This still triggers a wash sale, and the disallowed loss cannot be added to the cost basis of the IRA purchase because IRAs do not have a cost basis in the same way taxable accounts do. This means the loss could be permanently disallowed for tax purposes. Understanding the wash sale rule is fundamental for maximizing the benefits of tax loss harvesting and ensuring compliance with tax regulations. By recognizing the 61-day window and carefully defining what constitutes a substantially identical security, you empower your clients to make informed decisions, avoid unintended tax consequences, and ultimately enhance their long-term financial strategy with confidence.